Canoe EIT has been a major part of my passive income strategy in 2021. It has been a good year for both me and Canoe. With the release of their 2021 annual report, I think it is time to do a deep dive on Canoe. We're going to see if they are still a passive income superstar for my 2022 portfolio, and we will begin right now. When I first encountered Canoe, I was of course mesmerized by their dividend yield, which was an astounding 11% at the time. That yield has dropped by more than a few points since then to 8.345% at the time of recording. Holy banana bread, that does seem kind of terrible, but it really isn't at all. The reason for the yield drop is that since I bought in, their return on investment, or ROI, has been 141.3%. Canoe has been growing, and as their share price increases, the yield goes down, even though the dividend remains the same. They have been paying 10 cents a month per share for a very long time. One of the first things I learned about Canoe is that they are an income fund. An income fund are, they're forms of mutual funds or exchange-traded funds that focus on income via interest or dividend-paying investments. Basically, they are like an ETF, but with better returns based on their investment portfolio. Canoe EIT has been around since 2015 when they were formed in Calgary. Initially, they were called Canoe Energy Alpha Fund, or sometimes I'd like to just call themselves the Fund. The fund primarily invests in short-term securities within the oil exploration, development, and production sector. They also invest in the companies that support these sectors. For example, they are invested within the financial sector, but the parts of the financial sector that support the oil and gas sector. Now, the oil and gas sector, they make up 85.8% of their net assets. So it is really no surprise at all that they did so well over 2021. Their investments are very extensive, but a few of them include Spur Petroleum, Headwater Exploration, Synovus Energy, Canary Biofuels, Carve Energy, Synaptive Medical, Summerland Energy, iShares Global Clean Energy ETF, Brookfield Renewable, iShares S&P TSX Capped Energy Index ETF, and Invesco Solar ETF. Now, of course, in addition to this, they also hold some bonds, mostly American, and they do employ short selling on some securities to bolster their profits. Speaking of profits, they have a history of making more than they anticipate, and as a result have been known to provide a special distribution at the end of the year. The special distribution for last year was not communicated super well, and as such, many folks were confused about how this was being handled. It was done as a notional distribution, which basically increased the adjusted cost base without changing anything else. That meant anyone with EIT shares in a non-registered account could sell them at a higher adjusted cost base. Thus, there would be less capital gains on those shares. Of course, the downside is that the increase in the ACB, that adjusted cost base, was actually taxable. A lot of people were a little confused about it, and they wanted to know, why did they do it that way? Why didn't they just pay out dividends instead, like bonus dividends other companies tend to sometimes pay? The answer to that is to pay out bonus dividends, they would have had to liquidate shares to do so. And they didn't want to do that because with the current state of the market, it would have triggered some pretty sizable capital gains. So if you think about it, more than 80% of their stocks are in the energy sector, and that energy sector is absolutely booming. I could see those capital gains would have been pretty big, and that could have actually hurt the fund. Now, a second question that a lot of people will ask is that, why not just boost your dividend, and that way there you don't have money left over at the end of the year? Normally, the fund makes what is needed to maintain their current dividend. But with that boom we talked about in the energy sector, that is why they had that excess, and thus the special distribution. If they were to boost their dividends because of the pump in the energy sector, once that pump was finished, they would probably then have to lower the dividends again, and people wouldn't feel very good about that. So that is the reason that they went with their special distribution. Okay, let's look at a few of the fundamentals. First of all, we have good earnings per share with an EPS of 4.35. Obviously, that will drop when the energy sector comes back to earth, though that may be a few years off. Their price to earnings ratio is 3.30, which is down a little bit from 2020 when it was sitting at 19.78. A lower PE ratio tends to show a company with lower expectations for growth, and often that can lead to that company outperforming those expectations, which is absolutely a good thing. Their price to book ratio is 1.01, which means they are slightly overvalued, but not by a lot. In fact, a price to book ratio of 1 means that they're exactly at the right price. So you can see they're not that far off the mark. Their beta is 0.19. Thus, they are very much less volatile than the market in general. In fact, Canoe did really good in some of the recent market pullbacks, which validates this low beta for sure. When it comes to growth, in the last year, the EIT price rose from $11.42 to $14.38 for an ROI of 125.9%. And that does not include the dividends, which easily pushes your total return on investment up around 135%. That's not too shabby. Full disclosure, I buy EIT for the dividends, so the ROI going up is nice, but at the same time it's not, because that means I'm paying a little bit more for the same amount of dividends. So what exactly is my verdict on Canoe EIT? Are they still the superstar of my passive income portfolio? The simple answer is yes. There are other dividend stocks with higher yields, but they lack the stability and risk aversion I get with Canoe. I will still invest in many of the high yields, but when the market is looking shaky, I will fall those funds back to my old reliable EIT. One final thought on EIT is that it is always good to remember that an income trust follows the same tax rules as a REIT, in that if held in a non-registered account, the gains are 100% taxable. So this is definitely a great TFSA or RRSP addition. Keep in mind that I am only presenting this information as the start of your research. A financial advisor should be the end. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.